Hi, today we're going to be talking about getting mortgage ready. I'm going to give you the 4 areas that I talk to with all my first time buyers. My name's Manda and I'm the mortgage coach. I combine mortgage advice with financial coaching. I've helped quite a few first time buyers over the last 4 years and I'm here to help you. Now let's get started. The first point I wanted to talk about is affordability. Now, affordability can be broken into what you can afford and what you can borrow. Now, when we're talking about what you can afford, the best way to do it is to look at your budget. What is your net income that comes in? What are all your commitments, your credit commitments that you will be paying after the mortgage? And then once you work out them, then there is a multiple depending on the lender, and that will figure out how much you can borrow. Now, the next thing is how much you can afford. Now, at the end of the day, depending on how much you can actually borrow will determine what your mortgage is, and that will determine what your monthly payments are. Now, your monthly payments can be determined by the product fee, it can be determined by the term, it can be determined by the actual deal that you go with. If it's got fees, if the fees are added to the loan, etc. So what you really need to do is look at what you earn as a net income and what your commitments are every single month. So as with borrowing, the borrowing is the total of all of the balances. So it looks at your gross income and then reduces all your credit commitments, like the balance of the loan, the balance of the credit cards, that kind of stuff. But when you're looking at your actual affordability is more on a monthly basis. So not only do they take into consideration what you pay monthly on your credit card, what you pay monthly on your loan or car finance, what you receive monthly as your net income, that's after tax, but they'll also look at expenses that you will have possibly going forward that you don't have right now. So things like utility bills, things like insurance, and things like council tax. So you need to take all of those into consideration. Now, what I try and do is when I see my clients right at the beginning, I know that they probably set aside a certain amount of money every single month for the deposit. Now, if we can match what is set aside for the deposit as what is going to be the mortgage payment, then you know that you've already been saving that amount every single month, so you'll be able to spend that amount every single month to pay for the mortgage. Now, the second thing I wanted to talk about is credit, and it's your actual credit profile, because at the end of the day, everybody says I've got a credit score of 999 or whatever it is, or it's in the green or whatever. But what a lot of first-time buyers don't realize is when you are actually looking at your credit profile, lenders, building societies and banks do not actually want your score. They don't actually say, oh, she's got 999 or he's got 999, I'm going to give him a mortgage. They do their own profile based on your original credit profile. So I would always find a multi-agency report, and that's a report that has all of the credit agencies. So that's your Experian, your Equifax and your TransUnion, and has all the information. Now, the things to look at that will help with your credit profile, the first thing they always look at is your address. They want to know where you live and what your history is, and if they can identify you. If you're on the electoral roll, even better. The next thing they look at is how much credit utilization you've got. So when we look at credit utilization, we look at your credit and how much you've utilized. So for example, if you have a credit card balance of £1,000 and you've actually you've got a credit card balance of £1,000, but you've got a limit of £3,000, then you know you've got 30% or 33% of the balance. Now, the other thing they look at is the debt to income ratio. So depending on what your salary is, say it's 25,000, they'll look at all of your committed expenses together. So if you've got 2 credit cards, 5,000 each, and then you've got maybe a loan of 2,000, then all of that together is 12,000. Now that is less than half of your actual income, so that's a good debt to income ratio. So when it comes to debt to income ratio, they like it about 50%. When it comes to credit utilization, they like it about 30%. All of that is considered when they're looking at your credit profile. They also look at the fact, have you ever had credit? So I've had clients have trouble getting mortgages because they've never had a credit card, they've never had an overdraft. In fact, they've never had a phone that they actually have a contract and they pay every month, because that's also a form of credit. If you buy furniture and it's buy now, pay later, that's also credit. If you've got a catalogue, that's also credit. If you've literally paid everything in cash and never had any, then it does make lenders a little bit nervous, because if you think about it, they're going to lend you more than likely, depending where you're going to buy, hundreds of thousands of pounds. And if you haven't even been able to manage £500, how are you going to manage £200,000? So they want to show that you've got a history of managing credit and managing credit well. So I would always recommend get a credit card, maybe set a direct debit up to it like Netflix or something like that, so it automatically goes every month. Cut up the card if you think that you will overuse it, but then set up a direct debit to pay it off in full every single month. And then they can see that you're using the credit card every month, every time the subscription comes out, and then your direct debit pays it off in full, and they can see that you're managing your credit quite well. So that is a very good tip. The other thing I would say is, when you're actually looking at your credit, check that everything marries up. So look at all the credit cards. Did you apply for all those credit cards? Look at all the missed payments and everything like that. Does that all seem right to you? Just double check everything. Check again the addresses, that they're all the right addresses. You have actually lived at those places over those dates, because property can carry credit commitments. And if you say you're registered to an address, or someone says you're registered there, and there's like a utility bill debt there, then it will come back to haunt you. The next thing obviously to look at is your financial associates. So if someone is linked to you for a utility account, a current account, a savings account, anything really, then it can have an effect on your credit. So just double check that. Now, the next thing I wanted to talk about is deposit. Now, at the beginning, we talked about affordability, how much you can borrow. Once you know how much you can borrow, then you can sort of see to yourself, how much deposit do I need? Now, at the end of the day, if you're a first time buyer, you only need 5% deposit. In fact, there are some mortgages that are 100%. Check out my video. That isn't always a good thing. But if you want to put down 5%, 10%, 20%, it's really whatever you can save. So by looking at how much you can borrow, you can figure out what is 10% of that, or 5%, or whatever you want. And then when you look at how much you can afford, how much genuinely can you afford to save for a deposit? How long do you want to save for a deposit? So you the information of deposit does coincide with affordability. Now, the last thing is mortgage preparation. Now, what I mean by that is, it's really useful to understand what a fixed rate is, what a variable rate is, what we mean by the deal, which is the product fee plus the actual mortgage, the interest rate. The other things to also consider when you're actually looking at the mortgage prep is understanding other elements of jargon, and that should really help you. At the end of the day, ask your mortgage advisor as much questions as you can. I love my first time buyers asking a lot of questions, because I love to talk about mortgages, which is why I do this channel. And the last thing I would like to talk about is documentation. So at the end of the day, they will be, if you're employed, they'll ask for 3 months pay slips and 3 months bank statements. If you're self-employed, they'll probably ask for 2 years of accounts. So that's either self-assessment if you're a sole trader, or if you're a limited company, they'll ask for your company books. But it's really important that all of those are clean. You're not living in your overdraft. You haven't got. They can also see So on the credit report, it will say if you've missed direct debits, but it'll also show on your bank statements, because if you do a direct debit and you haven't got enough money in the account and it bounces back, it does say in detail reversed direct debit. So that can also make a big difference. So at the end of the day, you really need to be aware of, first, your affordability, second, your credit profile, third, your deposit, and fourth, mortgage preparation. Now, I hope you found this video useful, and if you've got any questions, please put them in the comments. Please share it with other first-time buyers so they get an understanding of how it all works. But again, you can ask your mortgage advisor all of this stuff. Any good mortgage advisor will tell you this kind of stuff, but it's good to know up front. So if you've enjoyed this video, please like it, please subscribe. I give a lot of free content, and I'd love for you to support my channel. Thank you.